Welcome back to Yahoo Finance Live, everyone. While executives are optimistic in their hiring prospects across tech, finance, and manufacturing, to name a few sectors, job openings, they continue to remain near record highs and hovering in those levels here in the U.S. Joining us now to break this down a little further is Jonas Prising, who is the ManpowerGroup CEO and Chairman. Jonas, great to have you here with us today. Help us really kind of shed some light on this, because on one side, we have the record highs in job openings that we've been seeing the U.S. hover in this range of. But on the other side, you have optimism from executives that their prospects look good.
Well, those are probably closely tied, because as we conduct this research, and just to give you the background to the research, we interview about 40,000 employers in 40 countries, and we ask a very simple question. As you look into the coming quarter, are you going to increase your workforce, maintain it stable, or decrease? And we've seen very strong hiring intentions from employers globally across many sectors. A couple that you mentioned, clearly tech skills are in demand. Manufacturing, operations, retail, and wholesale positions are very much in demand. And so we're really seeing employers with a positive outlook into the second quarter.
And the reason that I led in with the JOLTS data most recently and those job openings data is because employers in America, according to some of your key findings, they were reporting the most optimistic regional outlook when compared to South and Central America, the Asia Pacific region, and then the Europe, Middle East, and Africa region as well. And so with all of that in mind, the sectors that are doing the best right now in terms of their prospects and actually converting as well, what are they?
Well, as you correctly point out, the U.S. labor market is extremely strong right now, but it's also at a global level the market with the biggest challenges that relates to labor supply into that hot labor market, and the JOLT data is a data point. The wage inflation is another data point. So it is increasingly difficult to find the talent that you need. Now, we've seen a positive evolution in the U.S. labor market in terms of people coming back into the workforce. And at this point, if you compare where we are today compared to where we were pre-pandemic, the difference is really made up of primarily women who have not yet fully come back into the labor market and an increased level of early retirement. Both of those, we believe, over time will come back to a greater degree and come back to pre-pandemic levels, which should help solve some of the labor shortages that we're seeing today.
That really shines a light on the depth of the she-cession as we came to know it early on in the pandemic as well. With regard to some of the inflationary concerns that consumers have expressed broadly and felt, whether that's pressure at the pump or even dating back to some of the higher and elevated prices that they saw in this most recent holiday season and even thereafter, how much of that and the prices that consumers are seeing is also playing a role in pushing people back into the workforce?
That clearly is a big factor in moving and attracting people back in, because they are seeing that wages are going up. But unfortunately, we had a brief window of real wage increases adjusted for inflation, in 2019, parts of 19 and 20. But with the increasing in inflation now on basic services such as food and rents and gas, you're now seeing that even with the strong wage inflation that we're seeing, most workers don't see a real wage increase because the inflation levels are exceeding the increases that they're getting in their wages. So this is clearly telling them that they do need to come back, and also that we do need to get inflation to cool down, because it is putting a lot of pressure on a lot of people in the U.S. labor market.
Well, we also do know that the rising wages, and for executives and for management teams that have to consider on a rising headcount to make sure that they can continue to operate, how that also impacts margins. What are some of the expectations there, even as companies who are going to continue to report perhaps some of their financial metrics on a quarterly basis, how they are ultimately seeing their margins navigate through this period where they are also implementing higher wages across their workforce?
Up until this point, most companies have been able to absorb the inflationary increases and pass them on when they've needed to without deterioration in terms of their operating margins. But I do think that over time, this will be one of the levers to start to reduce wage inflation, because companies are finding it increasingly difficult to maintain pace with the wage inflation that they are seeing. And when that happens, cooling intentions tend to abate somewhat, and they tend to pull back a bit, which means demand goes back a bit. But we're not there yet. But I think as we look ahead towards the end of the year, we would expect that evolution to occur, where some employers would be saying, okay, I really don't want to add to my headcount to the degree that I thought I needed to, because wage inflations and wages are too high. I need to slow this down a bit. We haven't seen that yet, but over time, we would expect that some of that would help adjust the very strong demand in the labor market, so that you find a better balance between supply and the demand of work and workers.
Jonas Prising, who is the ManpowerGroup CEO and chairman, joining us today. Thanks so much for the time and the insights, Jonas. Appreciate it.